Welcome to our webinar on European M&A. I'm Iveli, M&A partner based in Paris. Clifford has recently conducted a global M&A research study in conjunction with the Economist Intelligence Unit. The research focuses on Europe as an investment destination, and the report is based on the views of about 400 senior executives from large multinational companies across the US, Europe, Asia Pacific, and LATAM. Today, our panel discussion will explore some of the key findings from the survey and also our own insight in relation to Europe. Today on the panel with me are Arndt Stengel, M&A partner based in Frankfurt, who is our head of M&A practice in Germany, Javier Amantegui, M&A partner based in Madrid and also the co-head of our LATAM group, Roger Denny, head of Asia Pacific M&A based in Hong Kong, and Ivan Present, M&A partner based in New York. If one look at the global M&A market, it's clear that activity has remained weak over the past year, and this continues into the first half of 2013, unfortunately, including in Europe. The value of European M&A has fallen by over 50% from the record level of 2007, and Europe's share of global M&A fallen from 40 to 30% currently. Europe is suffering from low economic growth, if not no growth at all in some countries, and even recession. And the recent difficulty of the Eurozone are still taking their toll on M&A in the region. This difficult environment makes the finding of the report even more interesting. So let's start by looking at the key message coming from the survey of global executives. Arndt, what is for you the most important message that we get from the report?
Yes, Yves, the key message for me is, and I think for all of us, was that actually Europe is the second most desirable destination for M&A activity right after Asia Pacific, and that means it is more attractive for investors than the United States, Latin America, Middle East, or Africa with the distance.
Shall we start by looking at what makes Europe an interesting destination?
Yeah, that's certainly the size, the location, the population of wealthy consumers, and then it's also the high number of high-quality assets, industrial technology, brands. And Europe is very attractive in terms of its developed infrastructure. The technological advancements and talents, the good regulatory framework must also be mentioned. But then, of course, Europe is quite diverse.
Okay, shall we start now by looking at top-level perspective from some of the key individual markets within Europe? I mean, Javier, can you start by giving us some insights from the Southern Europe market?
Sure, Yves. Thank you very much. Well, at first glance, it will appear that the south of Europe is not a top destination for M&A activity according to our report. However, the market has been and continues being active, and we have examples of that. The Euro 3.3 billion acquisition of Avio by General Electric, and the Euro 5 billion purchase of Repsol LNG assets by Shell. I would think that the reasons for the flow of deals in these countries are twofold. It is the attractiveness of the companies being acquired themselves, such as the Italian brands, the manufacturing know-how and technology, and also the Spanish top infrastructure-related and energy assets. Also, the positive reflection of the implementation by these economies of outstanding reforms, as shown by the reasonable and sustained level of the respective premium risks. And finally, and also as described by the respondents, the strategy of focusing on core assets by companies in Italy and Spain is feeding the market with good acquisition opportunities out of the companies being divested by large multinationals based in both countries. And I will add that some of these acquisitions may likewise provide a gate to entry or accessing emerging markets such as Latin America. We may mention in this respect the sale by Telefónica to Bain Capital of Atento, who was a call center with operations in 11 countries in South American region.
Thank you, Javier. So things are not that bad in Spain. And Arndt, could you give us the perspective from Germany?
Yeah, sure. They're not that bad in Germany either. Actually, from a macroeconomic standpoint, Germany is doing quite well these days. That is due to reforms that we are reaping the benefits from that were instigated about 10 years ago, like social welfare reform and tax reform. And so these days we have quite a robust economy with a very low unemployment rate, and we've got an almost balanced fiscal budget, and that is reflected in the corporate space, where we've got companies that are generally posting profits that have returned to the levels of 5 years and earlier before. We have cash-rich companies, and therefore we have also very confident owners, be it funds, families, or groups of companies. And that means that those owners are not, well, when we look at how this translates into M&A activity, these owners are not willing to sell at a discount. Rather, they look at where they could invest their money elsewhere if they sold, and there isn't much opportunity. So a number of sellers hold on to their assets and would only sell at a price that fully reflects the value. On the other hand, there is overseas investors that look at Europe as a whole, that look at the uncertainties in Europe, and that come to the conclusion that even if it's Germany, they should only they should have a discount on asset valuations, and this is a mismatch. European buyers and German buyers are also not that much on the scene, given that other countries in Europe may have more problems than the corporates as well. And then for the large and transformative transactions, we see that they are, of course, not domestic ones because of antitrust issues and because you would like to have a certain diversity regionally. So that means you, when it comes to selling companies, it is often the case that the buyer universe is restricted. But it's not so much the case with smaller or mid-sized transactions, but it's definitely the case for the larger ones. And so assets do not come to the market because the buyer universe is limited, and there's this mismatch between perceptions and values.
And you have your election to come in Germany as well, which may impact on the market.
That's exactly right. We've got the federal elections in September.
Yeah. Well, election is a good transition with France, where we had a presidential election in 2012, and a year of presidential election in France is never a good year for the M&A market, and 2012 has been no exception to that rule. The first measure announced by the new government, it's fair to say, have created a bit of a chaos on the market, resulting in a lack of trust and confidence, which we know is crucial to restore activity and growth. The jury is still very much out regarding the official line of action of the new government. Will it be a pro-business attitude to stimulate growth, or will the government continue to raise taxes in an attempt to reduce the public deficit? So, I mean, as a consequence, the market in France is still very slow, and there is limited M&A activity, certainly not big-ticket M&A deals, but, so far, pretty low market. Yeah. So turning now to how Europe is viewed from the rest of the world. I mean, Ivan, could you give us some insight into how the U.S. market is feeling about Europe currently?
Sure. Our survey reflected that there's considerably more interest in Europe target M&A than there is in Asia Pacific, and even more so in Africa and the Middle East. The valuation of European targets is viewed as attractive from a U.S. perspective. For example, European markets are about double. We're over a 2009 low, whereas the U.S. is 2.5. That's about a 25% advantage in terms of valuation. The U.S. perceives that it has an affinity and a cultural identity with Europe in a lot of cases, and views Europe as offering a stable, more familiar environment, sophisticated legal market, well-articulated and protective IP regime, which is key, of course, in technology and healthcare and so forth, strong brands, and leading technology and skilled workers. This is perceived to be in contrast to what's offered by the high-growth, arguably, developing markets. And the U.S. markets are strong, and the management is sufficiently confident to embark on some acquisitions. It's a question of scale and target, but there's an interest level there. Well over half of the U.S. respondents in our survey indicated they would be interested in making an acquisition of a European target in the next few years.
Thank you, Ivan. And what about Asia Pacific, Roger?
Well, thank you, Yves. Asian companies, particularly from Japan, China and India, have been active buyers in the European market in the past year. That's partly arisen because those companies have been adopting global strategies, and Europe is inevitably a key part of that. There's also been a drive to acquire technology, know-how and consumer brands, partly to grow businesses back in home markets, but also internationally. Most activity from the Asia-Pacific companies in the European market have been in the industrial sector, but also the consumer and energy sectors. There's also interest in quality real estate assets and hotels. And to illustrate some of the trends that we're seeing, we acted for Jiangsu Jinsheng, acquiring Oerlikon's textile component business in Switzerland and Germany. We've also seen China Bright Foods acquire the UK brand Weetabix, Trinity acquire Cerruti, and then in the hotel and tourism sector, we've seen Shanghai-based Fosun trying to acquire Club Med in France, and luxury hotel group Shangri-La acquiring hotels in Rome, Istanbul, Paris and London. And in the latter respect, those transactions are partly about building global businesses, but also trying to capture the Asian tourists who are increasingly travelling overseas. In terms of target jurisdictions, the UK, Germany and France are the most popular amongst the Asia-Pacific companies based on past year's transactions, with Italy, the Netherlands and Switzerland fairly closely behind. The survey that we've undertaken shows that those jurisdictions are perceived as similarly attractive in the year ahead, with most of the Scandinavian countries also joining them as popular destinations. To counterbalance, though, that level of interest and activity, many Asian companies are much more focused on growth and opportunities in Asia. There are concerns amongst Asian executives about Europe, particularly around the low growth environment, and some residual concerns about the political and economic stability in the region. Chinese and Japanese companies are also concerned about how they can go about properly integrating European businesses into their global network. And there remain significant concerns about national protectionism. In the Clifford Chance Finance Asia survey at the end of last year, 2/3 of the companies identified that as one of their major concerns in terms of doing outbound M&A. It's an area that we believe can be overcome if it's well managed and addressed early in the process, but that concern is still there. And then finally, true of all M&A markets at the moment, pricing is key to consummating the deal, as Arndt commented on earlier.
Quite interesting. I mean, if we now look at how do the international investors feel when they consider investing in Europe, do they look as if they would be investing in emerging markets or not? Javier?
Well, I think Europe right now is more probably about psychological uncertainty than anything else. So emerging markets and the European continent cannot yet compare as to ease of doing business. The 2012 ranking prepared by the World Bank shows 20 European countries within the top 35 positions. And it is precisely the very advanced status of the legal framework in Europe that sometimes generate some new burdens, such as the extraterritorial regulations on anti-corruption matters. But in my opinion, the benefits of a developed legal infrastructure override the risks. This is corroborated by the results of our survey, which show a clear preference in Europe for traditional M&A versus joint ventures and partnerships, which is the more conservative approach common in growing economies.
Yeah. Well, thank you, Javier. And what about the US, Ivan?
Well, as I mentioned before, investors like the European market in the U.S. The process of implementing transactions in Europe is similar to that in the U.S. in many respects. For example, 75% of U.S. respondents preferred to engage in partnership and JV structures rather than traditional M&A globally. But in Europe, it was less than a quarter of the respondents where they preferred to use JV structures as opposed to an outright acquisition, and I think that's because there's a higher comfort level perceived to be. This comfort level is coupled with high consumer spending depending on the market in Europe, which is appealing. Of course, the money's going from the consumer's pocket, depending on the company, but essentially into the pocket of the company. If you don't have the consumer spending, it's challenging. I think European M&A is looked at as primarily an economic and market risk. It's not considered a legal or social risk, and that's not the case. It's easier to make a principled decision when you've limited the variables.
Well, thank you. What the survey suggests is that fundamentals are largely in place for the European market to start to recover. But we know that for the confidence to come back on the market, we need to have a few transformation deals. And although we do have a bit of M&A activity in the region of 500 million to 1 billion deal, we have not seen, and this is highlighted by the report, any major transformation deal. Why is it so, Arndt?
That's exactly right. So Germany is a good example where some of the largest deals last year, for example, Volkswagen's integration of Porsche, were agreed long before, or they didn't even go through, like the Rhön Klinikum takeover attempt. So, we understand that slower markets and slower consolidation mean a lesser sense of urgency. We also experience this when we look at how transactions are actually being done. Everything takes much longer than it used to take. There are exceptions to that in particularly active markets. If you look at Germany, the energy market is very active because of the political decision to move out of nuclear energy. And there we have, for example, the EQT, E.ON waste-to-energy transaction and other investments to provide grid connection for offshore wind parks that are really very sizable. But transformational deals require confidence. Mostly they are cross-border, and for many corporates there is less confidence when they look abroad. So just as an example to that, the research actually showed that there is a bias against the Eurozone. We found that countries that are, when asked which is the most attractive destination for M&A in Europe, then that when you list the countries, you find that the non-Eurozone countries are very, very, very much favored against the Eurozone countries. It's factors like this one that mean that boards are actually hesitant, and that is, of course, mirrored with the views of investors and shareholders.
And what about the U.S. investors, Ivan?
Well, I think this again relates. I mentioned stockholder activism before. This again relates to stockholder activism. There's a microscope on boards and on management today, and on the returns and so forth. So the boards have a conundrum here. They have to be active, but they can't make too many mistakes. And in a way, the ordinary interactions with the investing base are becoming more like the activity and the PR campaigns you might engage in connection with unsolicited acquisitions and contests for corporate control, because you're constantly trying to keep the company running properly, grow it, and keep the activists happy. So what tends to happen is the board engages, and this is what we've seen with European targets, in a series of smaller, non-transformative transactions, but activity nonetheless, so it's hard to criticize them for being inactive and just allowing the company to move along of its own accord.
Yeah. Well, one area that is highlighted in the findings of our report is that there is some M&A activity again in the region of 500 million, as we said. But there is also some distressed assets transactions, although probably fair to say less than what we were expecting. Maybe with the exception of Southern Europe, where there seems to be more distressed asset activity. Is that right, Javier?
I agree, although I will distinguish between two different situations in the south of Europe. There are consumer sector companies facing difficulties to service and repay their debts because they are suffering from a fall in internal demand and high levels of leverage, and in Italy and Spain, and these corporations are looking for new capital or maybe easily taken over at low prices, or even be the target for hybrid debt to equity instruments. And separately from that, there exists pure distress real estate related assets and debt coming from insolvent promoters and banks and their restructuring in Spain. Both sources of deals are offering interesting opportunities for financial investors specializing on troubled debt, real estate or companies, mostly coming from the USA. And this is consistent with the outcome of our report, as almost half of respondents say uncertainty is increasing their appetite for uncertainty in Europe is increasing their appetite for M&A.
What the report highlights is that asset valuation, remains potentially an issue with some distortion between the seller's expectation and the buyer's objective. And is it the case in Asia Pacific, Roger?
Well, there certainly seems to be a valuation and an expectation gap, which is limiting the execution of deals at the moment. We're seeing on the potential sell side some hope that valuations will improve over time. And also a sense that if you don't really need to sell, then why should you? Many companies around the world have got plenty of cash on their balance sheets, and selling assets at this stage may just be adding to that, and then the consequential pressure from shareholders to deploy that cash in one way or another. On the buy side, conversely, about 2/3 of the Asia-Pacific respondents felt that asset valuations in Europe were either undervalued or about right. And we've seen some great examples of bargain hunting, notably Hanwha and their acquisition of Q-Cells, a respected but financially troubled German solar panel maker, which allowed Hanwha to acquire not only a symbolic brand but also a skilled team of researchers. An acquisition made at I think 233 million euros, when a valuation some 3 years ago was suggesting a value of just over 1.5 billion euros. And they're definitely a company that's looking for more opportunistic acquisitions in Europe. The real question, absent clear bargains like that, is how many other deals will get done and who will be the buyers. The survey results show that the expectation is that large European companies are the most likely buyers in the European market, partly because of the reasonable valuations that we've touched upon, but also a greater familiarity amongst those companies with the local issues. US companies, as Ivan mentioned, are fairly closely behind in terms of interest in the European market. And then also Chinese companies and private equity funds were identified in the survey.
Right, Roger. Private equity is definitely on its way back in Europe. The financing difficulties subsided, and there is dry powder for acquisitions.
Yeah. Question for Javier maybe. Would you say that the continuing uncertainty is creating more opportunities on the M&A market in your region?
Yeah, I think it is that. And because countries more heavily affected by the monetary risk storm are making huge efforts to undertake substantial structural changes, and the continuing alliance between France and Germany is working well. So there is a dose of confidence there. And this is paying particularly in terms of macroeconomic perception. It looks like that investors are placing bets on the Eurozone. Besides, the area is now better prepared, and this transpires into more cohesion. As such, we are seeing increased immunity to the shocks. Think of the effects of the recent Cyprus bank seizure, and it didn't have the dramatic consequences it may have had 18 months ago. On the other point, which is the point of the bargains, adjusting assets prices to the new market circumstances is not necessarily bad, particularly with a strong euro exchange rate and when individual countries are unable to carry out separate depreciations. And finally, experiences demonstrates that opportunistic transactions are the early announcement of a recovery. Investors carrying out such deals are clearly already discounting that.
Yeah. And what about U.S. investors, Ivan?
Well, I think a confluence of factors, some that I've mentioned, make U.S. investors comfortable that this is a good time to seize opportunities in Europe. There's a strong domestic economy. The management and the board is somewhat comfortable about their current position. There are good valuations relative to the U.S. market, but at the same time, it's a relatively strong and healthy market in the Eurozone. There's a relatively strong dollar versus the euro and the pound. And I think there's some sentiment that the market may be overreacting to the risk. Certainly if looked at in the intermediate term, as opposed to, let's say, the short-termist view of many stockholder activists. As evidence that the risks are becoming more capable of principled evaluation, you start to see mechanisms in acquisition agreements, such as ones which address the exit of a Eurozone member, that are getting buyers more comfortable that these are risks. And this is something you saw and is very familiar in the U.S. back 13 years ago with the year 2000 issue and how you addressed it, and there was concern about its catastrophic, the specter, and of course people started to recognize it and address it. And I think once you start to see mechanisms, I think people can look at the risks, and as I was saying, they're showing up in acquisition agreements. They could look at the risks in a less emotional way, in a more dispassionate and measured way. As is often the case, situations of stress and uncertainty are as much an opportunity as they are a risk. As Warren Buffett, who's made at least several good investments in his investing career, said, be greedy when others are fearful.
Several good investments, as you say, yes. What about the financing market? I mean, the headlines have long been about the difficulty in borrowing, but this is not apparent from the research. Ivan, what's your view?
Financing, in short, I'll give you the conclusion as my introductory comment on this topic. Financing is not an issue. Companies are cash rich. Many financing alternatives are available if you don't have the cash, which is usually not the case. There's access to capital markets in various forms. There's so-called shadow banking. There's a very strong bond market, easy bridge financing. Almost 40% of the U.S. respondents say cash is their preferred acquisition currency, and they've all recourse to all these other options. So the takeaway from our survey was that lack of financing is not generally a problem for deal making. The total bond market, for example, it's been strong for years. It's increased, I think, around 5 to 6% on an annualized basis over the past 5 years. And the equity market's very strong. Now back at levels you saw back in some boom times. Will that translate over to the European markets is a question.
Yeah, and then that's at the other end of the spectrum. You've got the small and medium-sized companies that have still financing difficulties when it comes to larger transactions. So this has also to be noted. There is alternative sources of financing these days, like supply chain financing, but that's not good enough for larger acquisitions.
Yeah. Well, thank you very much, gentlemen, for your expert views. I think that if we try to make a conclusion, we can say that market fundamentals seem to be going in the right direction, as evidenced by the report. I think we have to remain extremely cautious, of course, The border between the road for optimism or the road for pessimism remains very thin. But I think there are some certainly encouraging signs, actually, from this report. If we had to take one takeaway message, Roger, what would it be?
Well, from an Asian perspective, it would be to watch out for Asian companies buying in the consumer goods and retail sector in Europe. The survey said that 60% of those respondents were in a good position to buy in Europe in the next year.
Javier, one takeaway message?
Well, I'm optimistic, as Europe didn't lose any of the traditional appeals we've been talking about, and there are enough signs to anticipate an improvement. I'm sure the region will emerge with some important learned lessons and stronger than ever.
Well, thank you very much to our panel experts, and hope you enjoyed this webinar, and goodbye.